Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. That's right. Welcome to Coasting in Retirement. How you doing today? Thanks for joining us. We are very excited to have you. Josh Knoll here, joined by the one and only Michelle Lee Melton. Michelle, how you doing?
I'm doing all right.
You doing good?
Yeah.
Great. Well, we have had a very busy last couple weeks, right?
Yeah.
Got moved into the new Fairhope office.
Ooh la la.
In Portico, which locals will know that's just east, the new development just east of the post office. Very nice, wonderful. I have to shave every day, look a little nicer, right?
Act right, yes.
Act right sometimes. Doing all kinds of cool things for our clients. It's been a very busy couple weeks. It's been great. It's also great to be back in studio once again here in Coastal College's recording studio, beautiful downtown Fairhope, working up what we hope is another great show. Now, listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store for you today. First segment, deep dive on our topic of the day. And with this one, we're going to have a little fun with money.
Yeah.
Second segment, about 20 minutes past the hour, fan favorite, Michelle with the news of the week.
That's right.
Third segment, roughly 40 minutes past the hour, Josh's crystal ball and
Big mouth.
That's right, big mouth. So buckle up. We got a lot to get to. Before we get started, quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm with offices in Fairhope and Orange Beach, Alabama. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that, don't worry. We'll repeat it several times throughout the show. All right, so Michelle, are you ready to have a little fun?
Always.
All right, so here's what we're going to do. We're going to use a fun little exercise to demonstrate the different choices that investors are faced with as we wind down here in 2023, particularly those of you listening that are in or near retirement, and particularly those of you listening that are confused about what to do in a high interest rate environment with your investments, right? The point of this exercise is going to be to demonstrate strategies for investing with all these higher interest rates going on. But we're also going to discuss some of the pros and cons of various investment choices. So, Michelle, for this exercise, here's what I want you to do. I want you to put yourself in the shoes of the folks listening and become the avatar for our listeners. So what you're going to do is you're going to pretend that you are close to retirement.
Oh, that's nice.
Or maybe you're already in retirement.
Okay.
All right. And let's set the stage this way. All right. So Michelle's the avatar, listeners. Let's say you, Michelle, you've done a good job of setting yourself up for retirement, for income in retirement. You've got a pension, which you do, right? You've had a long history of employment income, so your Social Security benefit will be healthy when you turn it on. You have, right?
That's correct.
And you've kept your expenses low. Maybe.
Mostly.
Mostly. We'll subtract the shoe expense out of that.
That's right.
But for this example, for the folks listening, let's say that you also have additional money that you've been putting away. Maybe you socked it away in a 401k, or in your case, a 403b, or maybe you've already rolled it to an IRA. Maybe you've got it in a brokerage account. Maybe you just have a pile of money at the bank. Or maybe, like a lot of folks, you've got a mix of all the above, where you keep all your money, several different accounts. For the sake of this example and time, we're going to simplify it and call this pile of money $1 million.
I like it.
And we're going to put it all in one location.
Okay.
Okay. And that location is going to be right in front of you. So what we're going to do to make this exercise a little more real, again, Michelle is standing in for the audience here. I've put
there's a lot of cash here.
There's a lot of cash on the table. We're going to try to describe this for you all listening because you can't see it.
I'm going to take it.
There are 10 $100 bills in front of you, Michelle, that is meant to represent $1 million. So what that means, simple math, is each $100 bill equates to $100,000.
I get it.
And I'm sorry I didn't have a spare $1 million in cash to bring.
Dang.
You're right.
Why not, dude?
I'm nervous enough just with running around with that kind of cash. So again, audience, Michelle's your avatar. And again, just like you, hopefully she's done a good job with her pensions and her Social Security and keeping her expenses low. And we'll add the little caveat that if she wants to, she has the ability to work part-time in retirement, which Michelle has no interest in doing.
I have no interest in that.
But we're going to leave that as part of our math equation. But even with all this good stuff going on, Michelle is still not quite sure what to do with her $1 million. Primarily because she's worried about making the wrong decision.
That's right.
And not having this pile of money when she needs it, or worse,
somebody squandering it,
losing a big chunk of it, right?
Yeah.
So let's start here, Michelle, with your $1 million, your 10 $100 bills representing $100,000 each, equating $1 million. Let's start with, in this exercise, what if you do nothing? What if you stuff that $1 million into your mattress, and then, of course, you have to live like a hermit because you only might find it out and rob you. What if you put that in a mattress? What's the downside or upside to this approach?
Well, it's going to lose value. It's not going to gain value. Let's put it that way.
So listeners, here's what I'm doing now. I'm taking part of hers, and I'm taking $100,000. I'm replacing it with $50,000. So now you have $950,000 sitting in front of you. Well, why would that be? All you did was put it in a mattress. Did the money shrink?
No.
The money didn't, but its buying power did.
Yes.
2023 inflation will probably level out. It'll probably end the year somewhere in or around 5%. 5% of $1 million is $50,000. You've now lost $50,000 of buying power. Okay?
Okay.
All right. So let's go totally opposite, and let's make you whole here. I'm going to put that $100 back. You still got $1 million.
Yay.
Let's go the totally opposite.
Okay.
Let's say you put all of your $1 million into the stock market this year.
No.
Okay? Now, here, listeners, bear with me. We're on the other end of the spectrum. So in October, here's what Michelle saw. I'm taking $200,000 away from her. Okay?
Oh, no.
Now, November, I'm going to give her back $150,000 of it. She's still scratching back to make some of her losses. And as the year has gone on, if I go previous years, the money has come in, the money has gone out. You've been times, Michelle, especially depending on when you came into the market, that $1 million might be down to $800,000. It might even be down to $700,000 as I pull another $100,000 away. How's that make you feel?
Not good.
Not good.
Angry.
Now, long term, as long as you've got good holdings, eventually you should start being able to add to that. But in this last couple of years, how do you feel about that, listeners? I am basically sliding money away back and forth.
He's taking it away.
How do you feel about that?
I don't like it.
You don't like it. Okay. So
nobody's gonna like that.
Fair. Now, what did we just physically represent? With the mattress example, we represented the power of inflation and what it does to the buying power of your dollar. So if you just stick in the mattress, or if you just put it in a checking account or a low interest savings account, it is right now, especially with inflation coming down, but still relatively high, it's losing buying power. On the opposite end of that, what we demonstrated with the stock market approach was volatility, one of Michelle's favorite words. You saw money come in, you saw money go out. Some people, especially for those of you folks that are younger, that have time to accumulate and make up for losses, fine, it's going to do that. But for a lot of you all that are listening, that are entering near retirement, you may have seen some of that and you may not be very comfortable with it, okay? Let's dive into a couple other examples. You ready?
Okay.
All right. So first, we're going to pick on variable annuities because I like picking on them. So here's what we're going to do, Michelle. I'm going to give you $70,000 on top of your million.
All right.
You now have $1,070,000 in your variable annuity.
All right.
That sounds good?
Yeah.
But wait.
Oh, no.
Hold on a second. I've got to take $30,000 back of it out for fees.
No.
And what I mean by that, not all variable annuities are this expensive. I don't mean to be a broad statement, but depending on the riders that you have in there, it's not uncommon for a variable annuity to have 3% expense ratio, even 2%. But you see what happened there. Michelle might have made a 7% gain, but she had to turn around and give nearly half of it back in fees. How you feel about that? I
don't love that.
Okay. Now, there's going to be some trade-off in that. If your account was down, most variable annuities have a death benefit on there. If your account had been down to $900,000 and you died, most companies will make you whole on that. But the point of that is...
But you're dead.
But your heirs will get it. But the point of that is there's going to be some heavy fees you pay in exchange for some of those guarantees. Got it?
Yeah.
All right. Let's shift the other way. Let's talk about money market funds, something we've talked a lot about lately. I've talked more about money market funds in the last 6 months than I did in my entire career.
Right.
Yeah, because historically they pay like 25 bips. I mean, there's nothing. So here's what we're going to do. You got $1 million. We made her whole, listeners. She has $1 million sitting in front of her. I'm going to put $50,000 on top of her $1 million. And that's it. There's no catch.
All right.
How do you feel about that?
I love that.
Okay. Now, here's the downside. Money market funds are short-term instruments with a floating rate. Doesn't mean it's always going to... Right now, they're above 5%. We'll talk more specifically down the road. But next year, that rate may fall to 3%.
Okay.
Well, now you still got 30,000. That still feels good, right?
Yeah, I mean, it's still some cream on top of the original.
Now, if it goes back, I don't have any change on me, but if it goes back historical rates, I'd be throwing a quarter or something out there.
You can round up.
Right. The point being is, for now, it is as probably as attractive on the money market funds as it's been in, well, I know it is, not if, it is as it's been in many years.
Rage.
And this would be a similar example to treasuries or bank CDs. So the interest rates are all fairly in the same ballpark of each other. Okay?
All right.
Let's pivot to bonds. Okay? So when we talk in bonds, corporate bonds, foreign bonds, U.S. bonds, municipal bonds, yada, yada, yada,
James Bond.
So here's what I'm going to do. You got your $1 million in front of you, right?
Yeah.
I'm going to give you $50,000 in dividend payments.
Okay.
That feels pretty good, doesn't it?
Yeah.
Right? But I'm going to take away $200,000 in value.
Oh.
Now, why is that?
Why is that?
All right.
Why are you so mean to me?
You will remember on one of our previous episodes about the effect of higher interest rates on bond prices. That's right. Yeah. So even though your bonds performed and it produced the interest that it said it would, in this example 5%, it produced that. If you had to sell those bonds on the open market right now, they would be worth less than what you paid for them. So
we did talk about that.
So when you look at your statement, even though you're getting the dividend or the interest payment that you were expecting,
yeah, that looks fun.
The value of your bond portfolio, of your fixed income portfolio, is fallen, and that's unnerving, right?
Yes.
And the reason is because investors right now can buy bonds at par. Par typically is $1,000. They can buy bonds at par with a higher interest rate than what many people hold on their existing bonds. Particularly if you have a longer term position, a longer term maturity on your bond, the longer the term, generally speaking, the greater decrease in price. Okay.
All right.
All right. Let's make you whole again.
Okay. Yeah. This part's better.
Back to $1 million.
Yeah.
All right. Now we're going to go to the insurance world. We're going to talk about multi-year guaranteed annuities, MYGAs.
Okay.
So I'm going to give you $60,000 on top of your $1 million. Michelle now has $1,060,000 sitting in front of her.
Okay.
How's that feel?
Yeah, I mean, it's trickery though, because you're giving it, then you take it away. So
not this time.
Okay.
I'm not.
All right.
Here's the trickery.
Okay.
Try to touch your money. Don't touch it. You cannot touch that money for 2 years, 3 years, 5 years, 10 years, however long you've purchased the MYGA for. Now, you can, most MYGAs are going to give investors usually like a 10% surrender-free withdrawal. So if you needed, in this example, to take out $100,000 on top of whatever your interest payment was, then you can do that.
Okay.
On some MYGAs, a lot of times, sometimes you can get the interest paid. A lot of times folks will roll the interest into the MYGA. Why do you do that? Because now in the next year, let's say in our example, the interest rate 6%, you're now getting 6% on $1,060,000, which is even more than $60,000 on interest, right? You understand that?
Yes.
But the trade-off is can't touch it, at least not all of it, right? Well, you can touch it.
It's just eventually.
Like if you were to scrape this $1 million off the table right now and you're in the first year of a 5-year MYGA, I'm gonna keep 100,000 of it.
Okay.
All right. Got it? Okay. Let's do 2 more.
I get it.
We're still in the insurance world. Let's do income annuities.
All right.
All right. So income annuities are, right, there's 2 broad types. There's SPIAs and there's deferred. SPIA stands for single premium immediate annuity. Usually those will kick in within, call it 30 to 60 days after you place the single premium into the annuity. Deferred, think of those as kind of like for those of you all with a pension where there's regular contributions over time, or you can still do a single premium, but you're going to defer the income that you're taking back out of that. So what I'm going to do on this example is, Michelle, I'm going to give you every year for this $1 million, you're going to put it into a SPIA, single premium and immediate annuity. And I'm going to give you $50,000 every year.
All right.
For the next 20 years.
Okay.
Or maybe the rest of your life. How do you feel about that?
I mean, I like that.
Okay. Let's go even further. Deferred income annuity, usually the longer the money can cook, typically, this all depends on your age and your life expectancy, but in general, the longer the money that can cook, the higher the payout. So on your deferred annuity, I'm going to give you $70,000.
Okay.
Okay. What's the downside there?
You tell me.
All this money is now with the insurance company.
Oh, so
it's gone.
No.
When you put the money into the income annuity, you are giving control of that $1 million in exchange for a guaranteed income stream.
I gotcha.
Okay. Not dissimilar to the pension on you all that have that y'all have
Don't
pensions.
know if that one's for me, but
okay. All right, last one. We'll wrap up with fixed index annuities. They're the flavor of the week, if you will. They've been the hot thing for the last several years. And so how this does is, Michelle, and I'm going to try to keep this simple with all this cash we got piling up here.
That's right.
But so you've got $1 million. You put it in what is referred to as an FIA. Okay. You're not going to be invested in the market. Otherwise, you would see the ups and downs that you would see if you had a stock market portfolio, a mutual fund, or even a variable annuity. You'll see ups and downs in what's called the sub-account on a variable annuity. If the market's up, your value's up. If the market's down, your value's down. You don't see that on FIA because what they do is they'll track an index. Let's use the S&P 500 as an example. If the S&P 500 is down for the year, on the FIAs, they have what's called a point-to-point annual crediting. If it's down 10%, what's going to happen to your $1 million?
It's going to go down.
Nothing. No.
Oh, it just hangs out?
It just hangs out.
All right.
So zero is your hero is how they're sold, but you get made hold on your million. Now, on the flip side of that, let's say that your index that you're tracking, again, we'll use S&P in this example. Let's say that it had a great year and it made 14%.
All right.
Not bad. Okay. Well, here's the trade-off. In exchange for you, zero is your hero in protecting against losses, I am now, listeners, I'm taking $40,000 back because the cap rate on this FIA is 10%. So the insurance company keeps the cream off the top on that index. In this case, 14% minus 10%. They're keeping that difference. In exchange, they're protecting you against losses in the long run. Okay?
All right.
The other problem, the FIAs will have more immediate liquidity and definitely than an income annuity. That's money you're handing over, and unless there is a really special case, you're not getting that bulk premium back. MIGAs, you can get the money, but you're going to pay a surrender fee during the maturity. With FIAs, you've got a little bit more liquidity. The trade-off for some of these things is called surrender period. Generally speaking, on a lot of FIAs, now there's FIAs where surrender periods all over the board, but for a lot of the ones that are getting sold right now in the market, you all need to pay attention that, generally speaking, the greater the upside potential and the greater the potential income production means the longer surrender period, which means that $1 million, you might not be able to touch all of it for 10, sometimes even 12, 14 years on some of these things. Now, for folks that are looking for long-term capital preservation and potential income production, might be the right solution, right? Yeah, we utilize them, as you very well know, because you've heard me say it a million times. My problem with them is they are often sold in the hammer looking for the nail sales process, right? Okay. Feel good about all that? You understand? Makes sense?
Sort of mostly.
Mostly? Well, so again, we talked about, and we can rewind this, listeners. Go to our website after this episode if you want to hear this again. We put the episode up every Monday after this airs on Sunday. But we talked about if you've got $1 million, again, you've done a good job. Social Security, maybe you got a pension, maybe you don't. But you've got some money, whether it's in a retirement plan or it's sitting in what's called a non-qualified account. You've got money here and you've got options. Some of it's going to be guaranteed interest. Some of it's going to be some upside potential with downside gain. Some of it's going to be directly correlated or even invested in the stock market. But there's going to be multiple interests. All have pros, all have cons. If you're uncomfortable with what you've been seeing in your portfolio, particularly those of you all that are seeing ups and downs, or maybe you're confused about some of the different fixed income and annuity options, or there might be some of you all even losing sleep on what's in your portfolio. First step is just make an appointment with us and bring your account statement. As Michelle knows, it's not uncommon for somebody to come into our office with an investment statement that's supposed to be invested a particular direction, a lot of times on the conservative side if you're in retirement. Once we do our analysis and all that, it's anything but. It's not that we don't have investors should avoid all risk, but your portfolio needs to match your risk tolerance and your time horizon, okay?
Okay.
All right. Well, there you go. That was our example. And for you playing along today, Michelle, I'm going to give you $1 million. Right. Which is actually, we're going to give you $100 because that's your going rate. and that math, if you do this show 10,000 times, you will be a millionaire.
Yay! You gotta do it more than once a week. Yeah.
All right. Well, listeners, how do you start the process of working with us? It's easy. First, set up a no pressure, free, no obligation conversation. You can do that by calling 251-327-2124, or you can find us on the website. That's gulfcoastfa.com. So that's Gulf like the Gulf of Mexico, Coast as in the show title, FA as in financialadvisor.com. On there, you can send us a message directly, or if you want to, in the upper right-hand corner is a calendar link. It's in blue. That will put a little 15-minute conversation on my calendar. Make sure you include your phone number or your preferred contact info, and we'll get that set up, and we'll have a conversation. The rule is if we can leave you, our thing is if we can leave you better than we found you, that's what we try to do. All right? Very good. Well, folks, coming up next, every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those you in or near retirement. So I want you to join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week Michelle scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially any articles that pertain to those of you in or near retirement. Our job is to help you all understand how these headlines impact you, especially when it comes to your money. And a little side note, if for those of y'all want to actually read the articles, we do include the article links on our show transcript, which you can find on our website, gulfcoastfa.com. Just look under the podcast tab and look for the particular episode you want to listen to. So with all that said, and without further ado, here's Michelle with the news of the week.
Okay, well, firstly, the government did not shut down.
Okay, yes. Is that news of the week? We passed a part of short-term?
We made it. I mean, I know another show we talked about that.
We did.
Because you always say it's a hoax.
Yeah. News to ignore.
That's right. Okay.
Yeah, she's referencing a past episode we had where I gave 5 things or 7 things for retirees to ignore, and part of it was government shutdown news. Ignore it.
I think we've almost shut down 3 times this year.
100%.
Okay.
It's a political play.
All right.
What you got?
All right, Josh. For the first time in show history, you and I found an article so useful we are referencing it twice. It's from Investors Business Daily, and it's titled "Strategies for Investing in a Rising Interest Rate Environment." We pointed out last time this article discussed bond portfolio diversification, plus listed the industries that tend to do well in a high interest rate environment, as well as the ones that tend to do poorly, like auto sales and retail. Towards the end of the article, they had a phrase I'm not familiar with called the illiquidity. Illiquidity.
It's a tough word.
It is hard. I was practicing it last night. Illiquidity premium.
Right.
This section also talks about having uncorrelated assets in your investment portfolio. So what in the world are these folks referring to?
All right. So what they're talking about in this particular article is the private credit market. And just for sake of this show brevity, that's definitely individual case-by-case discussion with investors. Yeah, that's something. Illiquidity can refer to anything that locks up your money without a ton of control by you, generally speaking, in exchange for either some guarantees or, in this article's example, the possibility of robust returns.
Ooh, I like robust.
One example that listeners may recognize is from the movie The Big Short, where right before the housing market crash, Christian Bale's character, his clients were demanding their money back.
Josh has a crush on him.
Yeah, he's one of my favorites. But they were demanding their money back, and he was refusing, mostly on the grounds that he had locked up a lot of their capital in short positions on collateralized debt obligations, or CDOs. If you remember, plain English, he was betting against the mortgage industry, okay? So he had money locked up in an illiquid position. Other examples, closed-ended funds, non-traded REITs, even insurance products like MYGAs have some version of illiquidity. The reason that the article mentions both illiquidity and uncorrelated assets in the same section is that because there can be some bleed over. Sure. That investments that move independent of the stock market, which is uncorrelated, or possibly even move against. Savvy listeners will recognize that as kind of a sales pitch for gold and silver. You can also apply that to fine art or even some REITs. The thought being that when the stock market is volatile or falling, investment dollars will flood into things that produce gains independent of stocks and bonds, okay? Right. Short note, crypto was supposed to be an uncorrelated asset, but that's proven mostly false. And in the case where people steal your money, it's also proven to be illiquid. So, but I digress. I think we talk more on that later, don't we?
Yeah, we do.
Yeah, very good.
Stay tuned.
So yeah, that is uncorrelated, and illiquidity a lot of times are used similar. They are for things. The best example would be gold and silver. Gold and silver are supposed to move as a hedge against inflation. They're also intended to move against the stock market. In its rawest form, both gold and silver are definitely illiquid, but there are obviously bond and silver funds, but that's a conversation for another day. What you got next?
All right, next up is an article from a website that I believe is industry-facing in your world, Josh. Advisor Hub.
Right. It's a good one.
They have a recent article titled Market in a Minute, The Impact of Rising Interest Rates. Even though this website is geared towards guys like you, nerds, I picked it up because it gave some behind-the-scenes data on how some investments have been hit the last few years with high interest rates. As anyone holding bonds or bond funds learned this year, rising rates have driven down bond prices and ate away at portfolio values, especially anyone holding long-term treasuries. But this article listed one fact that I think will even surprise you. Did you know that the ETF that tracks the value of the 20-year Treasury bond has lost 50% of its value since 2020?
Wow.
Did you?
No.
Okay.
Not until I read this article.
Did you also know that the more broadly diversified Bloomberg aggregate bond index has fallen over 20% in that same time period?
Yes.
You did?
I did know that.
Well, that sounds like a lot for bond funds.
It is.
And it ain't good.
Those are losses that you usually associate with equity funds. Bonds
right.
In general, bonds, or not in general, just for listeners, bonds are loans you are making to a municipality, to the federal government, to a corporation. You're making that loan in exchange for some type of guaranteed interest rate, yield, if you will. Equities would be actual individual ownerships of people. If you want to own a piece of Apple, you buy an Apple stock. If you want to loan money to Apple for interest, you buy an Apple bond. Got it?
Got it.
All right, so I'm going to give a little shout out. We just gave a presentation at Lake Osprey out in Josephine. Loved it. Loved the travel trailers and the fifth wheels and all the stuff. High level, my
people. Did you
people.
pick out some that you needed?
Oh, man, I drooled all over the place. But in that presentation, we had a graph of bond prices over the last 40 years. I just kept it 40 years, more or less, from the mid-'70s. And it was amazing how much worse 2022 was for the bond market than any other year.
Wow.
And in fact, Michelle, if memory serves me right, you and I did some research on a past show, and bonds had their worst year in 2022 since Napoleon.
Yes, Napoleon and Jonathan the tortoise that he hung out with.
Which doesn't even sound right, but it's mathematically true.
Yeah.
So more importantly, for those of you in or near retirement with a damaged fixed income or bond portfolio, more important is what can you do about it? Well, one option is just to ride it out. As we demonstrated in the opening segment, as long as your bond portfolio, your fixed income portfolio has integrity, even though the current price it commands on the open market is down, and it sucks when you look at the investment statement, it hurts, it still should be producing the agreed upon interest rate. The danger will, right now, if you're walking into fixed income, you're getting high interest rates. That's great. You want to be careful. Just see what you're getting that's in a callable feature. What does that mean? Callable bond means that the company can call the bond and reissue it at a lower interest rate. Again, conversation for another day, or for those y'all want to have it individually. Now, on the flip side of that, for those of you with a severely damaged bond portfolio or a damaged bond portfolio, there are programs we can look at to walk you through each and every position and give you options, particularly around using tax loss harvesting to clean up some of your bond mess. And not only does it help you kind of clean up your mess, but it will definitely help you feel better when you look at your statements. If you're interested in that, just give us a call. It's a fairly sophisticated analysis. As Michelle's called me a nerd several times, I am. And with this stuff, I love it. 251-327-2124. I don't love people being down on their bonds, but right. I love helping them understand what's actually going on and seeing if we can do what we can do to repair.
Turn it around.
Yes, right. Very good. All right, what's next?
All right, let's pivot to the Financial Post in their recent article, Which Investment Strategies Work Best When Interest Rates Are High? At first, I thought this article might be too closely resemble our first article in the segment about strategies for investing when the rates are high, but then the article took a totally different approach. And it's Canadian, eh?
Okay, I didn't know that.
Yes.
You pick up on that, of course.
Of course.
Quarter Canadian.
Quarter Canadian over here.
Gay Raj.
Yes, Gay Raj, ambrosia salad, all the things. Okay. First, it gave some history of inflation and interest rates boost starting in the 1970s when you and I were wee little creatures.
We were little babies.
Yes. Then it pivoted to two concepts for investors. The first one is called merger arbitrage.
Okay, all right.
Also known as risk arbitrage.
That's right.
Okay. And it sounded like gambling at best and witchcraft at worst.
Fair.
Right? I was much more familiar with the other strategy this article listed of buying small cap companies. Is that what Richard Gere did in Pretty Woman?
No,
I think he did.
He was a takeover artist. He would buy entire companies and then sell them
in pieces.
That's right.
He tells us that in the movie.
That's
okay.
right.
All right. Anyway, I thought about that. But I seem to recall our recent discussion on how the market gains of 2023 have been mostly carried by the largest of the large cap companies, which we've mentioned.
Yep.
There's some, yeah. So how does the advice in this article square with what we are actually seeing in the small cap investment space?
Well, so first, I was caught a little off guard by the suggestions, too. That's not where I thought the article was going. Right. So merger arbitrage, like Michelle said, sometimes called risk arbitrage. Basically what that involves is purchasing shares of a company that is targeted in a merger or acquisition.
Okay, so what's something that's done recently in news?
That's a great point, because I was thinking about good examples.
Yeah.
The best example I can probably give you would be what's going on in the TV and streaming space.
Okay, so things are getting gobbled up.
Right. So, for example, Disney just purchased the remaining 1/3 of the company from Comcast that Disney did not own. Anybody that was ahead of that or had inkling or was just taking a gambling bet that was going to happen could have positioned themselves at a lower price on the stock price, because generally speaking, when they do these buyouts, when they do these mergers and acquisitions, they will more often than not pay above and beyond current market price, right?
Okay.
Well, why do they do that? Because usually the price gap between the price being offered by the suitor and the current price is due to the risk of a deal not closing. You know, merger arbitrage strategy, that involves collecting the difference, or what's called the spread, between the offer or the closing price and the current market price. And so what does that mean? Why does the article even mention it? Why am I even talking about it? High interest rates are directly connected to merger arbitrage spreads because investors demand a higher rate, one that is above the risk-free rate, which is called the Treasury bill rate, to hold the shares, right? So they demand, like if you're making a bet, you're demanding a little more premium in exchange for your risk. Now, let's pivot to something, and these are things we can have a conversation about. We're not going to go in much greater detail on the radio show. Let's pivot to something that most investors are familiar with, and that's small cap funds. The argument that this article makes, and I kind of get it, is that smaller companies do not use as much leverage as larger ones, so they are less likely to be holding costly debt that becomes expensive to manage as interest rates rise. Generally speaking, small cap companies have higher growth rates, so they usually don't have as big a drawdown during a correction, and the idea is they can outperform in the aftermath. As we've discussed on the show, in contrast, most of the 2023 market rally has been with the largest of the large cap companies. In fact, you can point a lot of it to the Magnificent Seven, not the movie. So what has happened in the valuation gap between the large cap and the small cap companies is at a historical peak, kind of like what happened with bonds in 2022. We're seeing things that we just have not seen in our modern economy. And generally speaking, when that spread widens, it usually bodes well for the future returns of small caps, because large caps are like a big ship. It's harder for them to get up and going. It's harder for them to make corrections. Small caps tend to be more nimble. And again, as the article stated, generally speaking, they tend to carry less debt on the balance sheet. But also note, folks, when we're talking about small cap, it's kind of a misnomer, because to qualify as a small cap company on the U.S. market, I think you got to have at least $250 million.
It's not small
market
potatoes.
Cap up to $2 billion. So I mean, it's not. We're not talking about the plumbing shop down the road. We're talking about pretty large companies. But anyway, yeah. So there's an argument to be made. We will see. Yeah, we always carry a little small cap position because usually that's where you're going to see some growth. But it has not been great for 2023. We'll see if that changes.
Okay.
All right.
Last article, Josh. This one is from U.S. News and World Report, titled "What to Invest When Interest Rates Peak." I included this article because it provides a counterbalance to our first three headlines in this segment, all of which were written with the assumption that high interest rates were here to stay for a while. In contrast, this article argues that many economists believe the Federal Reserve is approaching its terminal interest rate and will begin cutting rates soon. I feel like this article might be suffering from premature speculation when it points to investments such as real estate and growth stocks, when both these sectors are showing signs of decline currently. Do you agree? I don't.
I think the article's a little early, right?
Okay.
I appreciate the optimism.
Right.
But I think we have yet to see the real pain in for one example, they mentioned real estate, right?
Yeah.
You've got so many headwinds now on the residential side. You've got high mortgage rates, right?
Very.
You have a lack of supply, particularly in high demand areas like where we live.
That's right.
On the commercial side, you have still the echo effects of COVID, where you just don't have
going to work.
You don't have as much robust activity in the office market. I can't really speak to the industrial complex as much. I think that Amazon has been kind of such a broad tide that has lifted all boats with all the activity and all the shipping and all the things we do. So industrial's probably stayed out a little bit, but at the end of the day, most of these activities, whether it's large scale commercial, whether it's a real estate subdivision, whether it's an industrial complex, they're most often than not, they're financed using loans that require an interest rate paid. Interest rates are high. And that's the intention. The intention is to reduce some of the supply and hopefully reduce the demand. Okay. The other thing they mentioned in there, Michelle, is growth stocks. Mm-hmm. Again, growth stocks tend to function better in a low interest rate environment. Why is that? Because usually when a company is in growth mode, we'll say the tech sector, we've talked about this before, Michelle, but Amazon and Netflix both lost money for years.
Yeah.
Now, how did they do that? Because they were able to borrow money cheaply.
That's right.
On the open market, and they were able to convince people of their concept and get folks to invest in them. The problem is people are going to be a little tighter with those things, and interest rates are higher, which tends to hamper growth. So I hope they're right, but I think they're a little bit. I think they're a little bit ahead of the curve. I think we got some more pain in certain sectors ahead of us, at least until interest rates start easing. All right, is that it?
That is all, folks, for the news.
Very good. Well, great job as always with the headlines. We feel these are important pieces of information impacting you of those in the in or near retirement. So listeners, if you have questions around the topics in our headline, or if you just have questions about your investment strategies or your financial plan, you can set an appointment with us by calling 251-327-2124, or you can go to our website, gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast as in the show title, FA as in financialadvisor.com. You can send a direct message on that website, or in the upper right-hand corner, you can click the blue calendar link and set up a free, no pressure, no obligation, no BS meeting with me. Very good. All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong?
Yes.
Now, how wrong?
Sometimes.
I don't know about that.
Very wrong.
Well, what do I think is going to affect investors in the near future, or maybe even long-term future? We get to talk about all these things and poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll here, alongside co-host Michelle Lee. So, folks, I'm opinionated.
No.
I have strong opinions at times. My defense, I would say a radio show host that wouldn't be very interesting to listen to.
Nobody's interested in listening to if they're wishy-washy.
Agreed, right?
Yeah.
No flip-flopping here.
Right.
So, and of course, I'm paid in my profession to offer professional guidance and opinions. Again, otherwise, what use would I be? Now, sometimes I feel so strongly about something, I talk about it publicly. And of course, there are times where I swing and miss. So if you want to hear me beat my chest or maybe eat a little crow, let's get at it with Jocelyn's crystal ball and big mouth. What's first?
Okie dokie. Okay, so on our last episode, we discussed the chances of the Fed increasing the Fed funds rate again in 2023. You predicted that the Fed chairman, Jerome Powell's obsession with a 2% inflation rate combined with an upcoming consumer price index report would probably lead to one more rate increase this year. And you said December.
I did.
Yes. So the most recent CPI report came in at 3.2%, with the core part of that index coming in lower than expected. And according to Barron's, many economists are expecting the Fed to keep rates steady for the rest of the year. Based on the reaction of the stock market, many investors agree with this sentiment. So what does your updated crystal ball have to say about that now?
All right. So let's parse that out a little bit. All right. So the CPI, the Consumer Price Index, came in at 3.2. Now, I do know there's a core index part of that, and I believe that removes, oh my gosh, I should know this, Michelle. It removes energy and something else. Forgive me, listeners. But the core part of that index came in just slightly lower than what had been predicted. Side note, as we've talked many times on this show, why people are in the business of predicting, I don't ever know.
They've not done a great job.
They need to just give a range and just keep it in
realistic.
that range. They get super specific, and then when it's above by a fraction, people flip out. When it's below by a fraction, people overreact. Because remember, listeners, in the short run, the stock market is a voting machine. In the long run, the stock market is a weighing machine. So what you're seeing right now is probably, in my opinion, just a little bit over exuberance, because 3.2, which me, country boy running a practice down here in Lower Alabama, serving the Gulf Coast, nowhere near the credentials of Fed Chairman Jerome Powell. But me, I would say 3.2 is probably a little more realistic in today's world.
I agree.
Than scratch and clawing this magical 2.
And there are articles that also support that.
Yeah. So with that said, I think that I'm going to hold steady for now, and we'll have to see where it comes in.
So you think December for Christmas present?
And here's why. Because I think that he's going to look at the employment numbers. We've got some really important
better than they predicted.
Yeah, which is bad for what they're doing with what they want to see is at least some form. At the very least, they want to see demand decreased. At the very least.
Okay.
Really, what they're angling for is a soft contraction, where things actually go the opposite direction. They want to have a soft landing, which means a soft contraction. They're obsessed with this 2% inflation rate. There's nothing I can say on the radio that's going to convince them otherwise. But I do
Deuces are wild.
I do think that if we see the market run free over here in the next couple of weeks, and we get a couple of really strong, we've got some pretty large businesses coming in with their quarterly and annual reports. If those things come in strong, Jerome Powell has made it very clear, as opposed to his predecessor, Alan Greenspan, he is not concerned about what the stock market thinks about him. He is solely concerned, just like Jimmy Carter's guy was back in the early 80s. He's solely concerned with beating inflation. And I think we still got more rides ahead of us.
Well, I hope you're wrong.
I hope I'm wrong too, because that'll change the mood for the Christmas holiday.
Yeah, that's what I'm worried about.
Even though it takes time for all this to bleed through the system, we're
already bleeding.
The Fed funds rate is actually the overnight lending rate for banks. It doesn't necessarily directly tie into a lot of the products and things that we do, but they all take their lead from that, right? So, yeah, that's what I think. We'll see.
We will see.
But for right now, I look wrong. To answer your point,
yes.
Yeah, right now my big mouth looks wrong. It looks like things are shaping up really nice. I hope that's the case.
Okay. All right. Next up is an opinion your big mouth spouted way back in July of this year. And unfortunately for you, Josh, you've already had your teeth kicked in on this one. So I'll try to play nice this time. On our July episode, we discussed current interest rates on fixed interest investments such as money market funds, bank CDs, and MYGAs, which stands for multi-year guaranteed annuities. We asked, or better stated, you asked, is this as good as it gets in regards to fixed interest investments? And the answer was almost immediately wrong, right, with interest rates rising across the board the following week and kept on going. So I would like you to update on us on two things. What is going on with interest rates being offered to investors on investments like these? And why does this matter to people in or near retirement?
Okay. All right. So two things. One, yeah, we reference, and it's always a gamble when you do a radio show. You try not to timestamp things,
right?
But we reference some very particular rates on some investment products that, looking back, it looks like we were talking about the Model T, and all of a sudden the Tesla came along. Because right now you've got A-rated insurance carriers offering north of 6% on 5-year MYGAs. I mean, I've been doing this for over 14 years now. And I've never seen anything like that. I mean, it's been a long time. I'd have to look at history. Money market funds. We utilize Schwab a lot. They've got you're inching up towards 5.5. If you've got $1 million or more to put in a money market fund, less than $1 million, 5.25 in that range. Now that floats every 7 days, but they've been above 5 for a long time. Payments that they're doing, some of the insurance products are offering, the payment rates, the things like that. Everything, like Michelle said, everything inched up, and it definitely is considerably more robust than it was even back in July when I was asking, is this as good as it gets? So wrong. Now, why does this matter to those of you entering retirement? So think about it this way. High interest rates, for the most part, for the economy, for your equity positions, for your long-term bonds, they suck, right? With your equities, it provides headwinds against growth because lack of access to cheaper capital, lack of expansion, lack of profit growth, lack of top-line revenue growth. All those things, high interest rates are a headwind to those things. Bonds, long-term bonds, you got a long-term bond, one time was paying 3%. You thought you were the cat's meow. Now bonds are paying 5+%. Your bond is underwater. It aggravates you. You're still getting your 3%, but when you look at your bond price, it's dented, and that bothers you, right? On the flip side of that, if you're on the lending side, if you are the person buying newer bonds, if you're the person looking at MYGAs, if you're looking at money markets, if you're looking at bank CDs, if you're looking at across the board, if you're on the side where you can invest the money in exchange for some type of interest rate, often a guaranteed interest rate, you're sitting with more options now in that regard than you've had definitely in your retirement years, unless you've been retired a long, long time, and probably for a majority of your investment career. You have to almost go back to the mid-'80s when laddering bank CDs was a viable retirement strategy.
Right. We talked about that last time
we
too
did.
A little bit. Yeah.
Yeah. So that's why it matters to those entering retirement. If you can stomach the pain, if you've already moved past the point where you need to get a mortgage or take a car loan out or do anything where you're paying a rate that really aggravates you. If you're on the flip side of that and your debt's already set, maybe you've got a low interest rate locked in on your home, or maybe your home is paid off, you've got an opportunity. And of course, you're never going to beat equities for the long, long run, but in the short run, you've got some really attractive options on interest rates that you just simply haven't had for many, many years. So, all right, what's next?
All right. So last one. Looks like one of your absolute favorite investments is back in the news.
God, no, Lord.
Yes. It looks like the price of Bitcoin is surging on hope that the SEC is going to approve an exchange-traded fund, or EFT, that allows people to invest in Bitcoin. It also appears that asset management giant BlackRock is moving forward with their own ETF that would invest in cryptocurrency's second most popular coin, Ethereum. It's Ethereum.
Ethereum. Yeah.
Never heard of it. Of course, I say favorite investment in jest because we've been quite open about our misgivings with crypto. You think it borders on a Ponzi scheme, and I think it's all just a whole bunch of witchcraft. But nonetheless, many are claiming that this most recent crypto winter is about to thaw out. So what does your big mouth have to say about this?
Okay, so a couple things. Yes, we have been openly critical about crypto, primarily because anything that takes money out of retail investors' hands and does it in a duplicitous manner where a lot of the gains that you saw, Sam Bankman-Fried, a lot of the money that was lost. Yeah, some of that was institutional money. There was there was people invested in FTX and the other things he did that could stand to lose it. But a lot of it was regular people that were trying to make up time or had fear of missing out, or like I like to say, FOLO. So FOMO is fear of missing out. FOLO is fear of looking old. Oh,
so yeah, because Bitcoin's hip,
and I coined that if anybody wants to steal that. But FOLO, fear of because Bitcoin's hip, right? The problem is it's a zero sum game, and what I mean by that, blockchain, the underlying technology, right now they have not had. There's no real proven use case. There's not. Crypto guy, come at me. I've asked you many times. I have people send me messages. Well, what about this? And every time you're providing a solution to a problem that usually doesn't exist or a problem that's already been solved in a better manner. No sovereign nation. I've always held this from the beginning. There's no sovereign nation on earth that's going to allow its private citizens to print private money, maybe back in the wild, wild west of the United States, but not anymore. And I think most importantly, crypto has been proven at this point to greatly assist in the black market of all kinds of nefarious activity. Okay? Here, I'm going to leave you this, listeners, for you readers. Michael Lewis has a recent book called Going Infinite it focuses on Sam Bankman-Fried. Ignore that book. I love Michael Lewis. Ignore that book. Instead, read a book called Number Go Up by Zeke Faux, F-A-U-X. I think it's Faux or Fox, whatever it is. Number Go Up. Read that. Come into it like I did, open-minded when I read the book, just like the author did when he was a Bloomberg reporter. Fascinating book. He dives deep. And I think that book, in my opinion, has helped explain what's actually going on in the crypto market as much as anything. So that's where I still stand. We shall see. Now, on the flip side, Michelle, if crypto develops into a $1 or $2 trillion little niche market,
you might change your stance.
Well, it's what it is right now. If it's got a little niche and it's got some things, if it becomes like the Game Boy of certain parts of the financial industry, fine, right? Just quit trying to convince retirees that it's their secret to riches.
Game Boy or GameStop?
It's not. GameStop, whatever. I don't know.
Game Boy's going way back.
Yeah, probably. That's right. Nintendo.
Yeah.
Atari. All right. Well, listeners, I hope you enjoyed a peek behind the curtain, how I form my opinion and my predictions. And more importantly, I'm willing to admit when I'm wrong, which isn't very often, but still. So now to our listeners that have more questions around the various investments and topics that we discuss, we invite you to reach out to us. You can call us anytime, 251-327-2124. If you're listening to this on Sunday, give us a call. You'll be surprised. Or you can make an appointment on our website. One more time, that is gulfcoastfa.com. Gulf like the Gulf of Mexico. Coast is in the show title. FA is in financialadvisor.com. One more thing before we close the show. This show is going out on Sunday. We want to wish everybody
a happy Turkey Day.
A happy Turkey Day. With everything being kind of shut down, we'll probably air this twice. So if you're listening the Sunday after, happy previous Turkey Day. Hope you had a great day. Hope you're with family like we're going to be.
I'll be another year older when we get back to the studio.
Yes, Michelle's got a birthday coming up.
That's right. Black Friday. You'll see me on the street shopping.
Yeah. All right. Well, that's it for us this week here in Coastal Retirement.
I'm helping the economy.
You are doing a great job. That's right. You're keeping it afloat.
That's right.
Yeah, with the $1 million that I gave you earlier in the show, that'll get you a little bit.
Yeah.
I want to give a huge thank you to my lovely co-host, Michelle E. Melton. Thank you to our awesome radio station, FM Talk 106.5. Many thanks to the provider of our show music, that's local band Sloth Racer. And as always, my sincere appreciation to those of you all that have joined us on this journey. We'd love to be part of your financial journey as well. So until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.